The overall thesis in venture investing is that you just don't make money if you're investing with the crowd. You have to be in front of the crowd. If you're not first or second to a market and making investments in those markets, it's hard to make money, right? Because if you're not in the leading companies, the number one player gets most of the market value, right? So you got to get early.
Welcome to Technoventure. I'm your host, Peter High. My guest today is Barry Eggers. Barry co-founded the venture capital firm Lightspeed in 2005, and today the firm is an unquestioned leader in the VC space with roughly $25 billion in assets under management and a portfolio of over 500 companies across enterprise, consumer, health, and fintech sectors. Barry specializes in information technology infrastructure with a focus on analytic platforms, cloud, networking, and emerging infrastructure. I look forward to discussing the founding and building of Lightspeed, his perspectives on emerging technology, and more through this conversation. Barry, welcome to Technoventure. It's always great to spend time with you, and I appreciate you doing so today.
Thanks, Peter. Great to talk to you again.
Thank you. Well, let's begin with the beginning of Lightspeed, if you don't mind. So as I just mentioned, it's 20 years since the founding. That's a great milestone. As you reflect back 20 years ago to the time when Chris Sheppy and Ravi Matre and Peter Nia and you co-founded the firm, why then? How did you think of having a point of view that might lead to some point of differentiation in the VC landscape?
Yeah, if you go back to 2005, it's hard to go back to 2005 because it was so different than today. But if you go back to 2005, there wasn't a lot going on in tech. It was sort of one of those, dead periods. We called it a desert. There just wasn't a lot of interesting stuff happening. It was sort of the time in between Web 2.0 and Web 1.0 and Web 2.0. And so we looked around and we had been with a firm called Weisbeck and Greer Venture Partners, and we were a good firm, but we weren't a top 20 firm. We were doing Series Bs and Cs and driving really good performance. But there were still a number of brands that had been established well before us that were getting the pick of the litter in terms of the early stage deals. But after 2000, there was a shakeout in venture. And a lot of firms went through generational transitions. Some just shut their doors. And so if you look at the top firms in the pre-2000 and the top firms after 2000, it drastically changed. So we looked around and we said, hey, there's an opportunity for us to actually break into the early stage sort of, investment real estate. We thought that was the best and most exciting and valuable real estate in venture. That is the first round where you get the most ownership and take the most risk. And we hadn't done a lot of those at Weisbeck and Greer, but we had an opportunity then in 2005 to really establish a firm as a leader in early stage. We started as an enterprise-oriented firm, that is business to businesses, because that's the four of us. That was our background. And we just set out to do that. Little did we know that from 2005 to 2025, the venture industry would not only change drastically, but it would grow, from, 20 to 25 times the size. And so we started it at the right time. And we sort of, we are a microcosm of the industry, and I can go through that later, but we sort of evolved with the opportunity set that evolved in the industry.
I would love to get into that. But before we do, talk a little bit about some of those early investments. You mentioned this period between Web 1.0 and 2.0, some opportunities, especially given the B2B backgrounds you have. We'll get into that a little bit later in the conversation, your own background at Cisco in particular. Talk a bit about some of those early companies that you invested in that were wins for the firm.
Yeah, and I would say that the company that probably on the enterprise side that helped propel us was a company called Riverbed, and that was an investment that was made by my partner Chris Sheppy, and we actually found that deal at the first round, first money in, and we invested alongside Excel. And at the time, Excel was this, and still is a very prominent firm. And here we are, Lightspeed, that no one really knew who we were, but we got into this deal. And it turned out to be a deal that returned, $500 million to the fund. And all of a sudden, that was propelling us in the enterprise sector. And And as we go forward, we sort of became very thesis driven. That is, as a team, we would sort of look at themes and we would say, let's test out the theme, and then if it's positive, let's make a bunch of investments in those themes. And so we did that. We did that in the area of flash memory for enterprise storage, if you remember that. We did it in the area of data analytics, and we built these portfolios of companies around those themes, and they performed very, very well. And so that really helped propel us on the enterprise side, because enterprise, to have credibility in the enterprise sector, it's more about your sort of body of work, right? It's the companies, your portfolio as a whole. Whereas on the consumer side, it's more about a prominent company. So on the consumer side, the investment that propelled us was Snap, and we can talk about that in more detail. But essentially, we invested $500,000 and we made over $1 billion, but that put us on the map and got us into the strong deal flow of consumer.
Yeah, very interesting. Um, yeah, let's talk about Snap and the origin story of that investment. Do I recall correctly that that's an investment that your daughter helped turn you on to? Do I have that right?
Yeah, isn't it funny? Because the yes, my daughter did. And it's funny because I'm an enterprise investor. So for me to bring, consumer opportunity into the group, people sort of look at you like, huh? Um, but my daughter, I came home from work one evening, and my daughter was there with a bunch of her girlfriends. They were sophomores in high school, and they were all sitting around the kitchen table, and they were all looking at their phones. And I sort of look at them and I said, "You guys are all here. Why aren't you just talking to each other?" And it turns out they're all on their phones using this thing called Snapchat. And my daughter, said, "Well, no, Dad, you don't understand. We're using this app that everyone uses." And so I asked her some questions about it, and she told me how often they use it, and everyone in the school is using it, and it's as popular as Angry Birds, which, if you can remember, back in 2012 was a pretty, you know, popular app. Um, and I came back to the consumer team and I said, "Hey guys, there's this app called Snapchat. Does anyone know about it?" No one knew about it. And it turns out it was very early, and it was really only being used by high school kids. So why would an adult know about it, right? And so I said, "Well, we got to find this." So a week later, more of the partners are saying, "Yeah, my kids are using it too." And so a week later, my partner Jeremy Liu had hunted down Evan Spiegel on Facebook, of all things, and we got a meeting with Evan. He came in and he showed us, what they were doing, and the growth was, 10,000 users to 100,000 users, and in 2 months, and all the metrics were pointing up and to the right, and all the signs that this is going to be something really interesting. And so we gave Evan his first $500,000 for about a little over 10% of the company. And we also brought in, because we found out about this at my kid's school, St. Francis High School in Mountain View. They have a venture fund that I'm chairman of that, on behalf of teachers, we invest money. And so we brought the teachers fund in for $15,000. And that eventually turned into $34 million for that school. So it was just a great story. And, and Evan and Bobby have done such a phenomenal job over the years. Evan's, built this thing from zero to several $1 billion, and just is a fantastic product leader and CEO. So we're glad to be part of that journey.
Talk a little bit, Barry, about how you have how historically you've gone about identifying some of the themes you talked about earlier. I know it goes through a lot of discussion across the partners, but as you've gone from flash memory to data and analytics now
Yeah.
into more modern technologies, how so in addition to having your daughter as someone who's sourcing deals for you, how else did you kind of have you gone about educating yourself as to themes that are worthy of investments and attention from a firm like yours?
Yeah, and my daughter hasn't sourced any other deals for us. She's off doing her own thing, but she reminds me a lot of the Snap sourcing occasionally. But um, we sort of created this sort of thesis-driven process where we said, and the thesis, by the way, the overall thesis in venture investing is that you just don't make money if you're investing with the crowd. You have to be in front of the crowd. If you're not first or second to a market, as a firm and making investments in those markets, it's hard to make money, right? Because if you're not in the leading companies in a market, the number one player gets most of the market value, right? So you got to get early to markets, and so to do that, you got to take chances. And so what we would do is we would make what we call an early investment, sort of a learning investment in a sector, and we'd learn. And we try to learn as fast as we could. And based on that, we would either not do more investments in that sector, or we would, back up the truck and we would try to make as many investments as we could in sort of adjacent companies within the sort of the supply chain, or whatever you want to call it, that in that sector. And a good example is we mentioned flash memory for enterprises. Our first investment was a company called Pliant. They were building a flash SSD, and they were a nice investment for us, but they taught us that this market was going to go faster than we expected, and it was going to take off. And so it led to other investments in things like Fusion IO and Nimble Storage and Nutanix, and go down, and Extreme IO, and you go down, and we built this portfolio of 15 companies, and the portfolio as a whole generated a 10x as a whole. So when you get these themes right, you have the opportunity to make a lot of money, and CEOs seek you out because you become the expert in those themes. Same thing can be true of data analytics, and AI is a little harder, but because everyone has gotten into AI. But what holds true in venture is you just have to be in front of the herd to make money.
I love the idea of learning investments, actually like getting some grit under your fingernails, getting skin in the game, using that to determine whether or not the initial thesis is correct and worthy of additional attention and investment. How, off the top of your head, unless somehow these statistics are readily in your mind, how often would the learning investment be something that you would learn enough to recognize opportunity for versus those that dissuaded you from continuing in that thesis area?
I'd say it's a little more than half the time, maybe two-thirds of the time, the learning investment came back positive. I mean, some examples of learning investments, we did some ed tech investing, and it just didn't compel us to build a larger portfolio around it. We've done an early quantum computing investment, and while that's coming, it's still coming, right? It's quantum computing is taking some time, but we're learning. We're learning about that with that company. So, again, it's a great way. You have to be in front of things to make money. And the nice thing about venture is the beautiful thing about venture capital is you can only lose one time your money. So, if you go and you do one of these learning investments and it just doesn't work out, you lose your money. But if it's working out, you have potential not only to make money more than one times your money or 10 times, but also do a bunch of other investments that where you can make, or a whole portfolio in the case of flash memory for the enterprise, 10x, right? So it does make sense as a way to do that. And I think that a lot of people are experimenting now that way with respect to AI across subsectors.
And how long, perhaps it's very different for different sectors, but how long would the learning take typically?
Well, hopefully as fast as possible, right? Because the faster you can identify whether this is going to be an interesting market or not, the better off you are. So I would say usually within 18 months, 12 to 18 months, you sort of know.
Yeah. And I mentioned earlier your areas of specialty, which include IT infrastructure, analytic platforms, cloud, networking, emerging infrastructure. Certainly, there's a lot there that you can see emerging from somebody who has a Cisco background, as you did. You were in the M&A group at Cisco for a time. Talk a bit about the development of your swim lanes, so to say, your areas of expertise, and how some of that you're learning at a place like Cisco impacted the way in which you saw the world and areas that you brought forward for the firm.
Well, I mean, in venture, you're constantly evolving. And I think the backdrop here is that in when I started in venture in 1997, I've been 6 years at Cisco, and I started in January 97. If you remember back then, Sienna was going public. It was the beginning of the telecom boom, right? Telecom equipment, CLECs, things like that, right? Optical. And so I had done some work at Cisco in both enterprise and telecom, but so in 1997, most of the investments we were doing were sort of telecom equipment related. And so we did a lot of those, and they were system oriented. The telecom, in 2000, the telecom bust happened, the bubble burst, and all of a sudden there just wasn't any investment in optical or telecom equipment or CLECs, and those things all, steadily went down to zero. So you either got out and made a great return or you didn't. But then we had to turn our attention to something else because there wasn't a lot of telecom. And so that's when the enterprise market started to be created: enterprise networking, enterprise infrastructure, and over time, software, right? Enterprise software. And that was replacing the last generation of enterprise software. In this case, it was enterprise SaaS, right? Was the newer generation. Um, but you have to constantly be sort of adjusting what you're doing. And, back then we were generalists. So we were doing everything. And so, we were doing chip deals and, equipment deals and software deals and services deals. And you had to do it all because the market wasn't very big. The market's now 25 times larger. So most investors are actually specialists now. And so you're a specialist in a subsect. You may have a subsector of AI that you focus on, right? That is your piece of the venture world. The challenge you have, though, in that specialist model is that sectors go in and out of favor. So you got to be really careful, putting too many of your eggs in one basket and making sure that you're evolving as the market evolves.
Very interesting. And I know from our past conversations, you've said that as a venture investor, uncertain times create the best opportunities to gain market share. You already talked about earlier in the conversation the necessity to be an early mover and be ahead of other investors, not just to sort of play into the herd. Talk a bit about that idea, though, that uncertain times create the best opportunity to gain market share.
Yeah, I mean, it's similar to the question of, you know, should you do controversial deals? But I've always felt like in venture, we do measure our market share. Our market share is the share of, the deals that are getting done. What's our share of those deals? How many are we seeing? How many are we doing? Plus the outcomes, liquidity. What is our share of the liquidity? What is our share of those top deals? So we're always measuring ourselves versus our peers. So you look to increase your market share because increasing your market share means you're growing, sort of AUM, dollars at work. You're growing the firm, and in the case of, the backdrop of the industry was that industry grew 25x, and so you're either staying still or you're growing. You don't want to be in the middle, but to grow, you sort of have to be in a place where you're evolving, right? And you're taking advantage of what's going on. And so the three biggest trends from 2005 to now that grew the venture market were: one, technology becoming a more important part of the ecosystem and of the economy, really, the world economy. And all you have to do is look at the top market cap companies in 2000, and most of them are oil companies. And today, and they're all tech, except for maybe Berkshire Hathaway, which has done a great job along the way. The second big trend is the globalization of venture. It used to be that all the deals were in the Silicon Valley, 80%, or in Boston, Texas. And now more than half of the deals are outside the US. So you got to be able to go global. And then the third big trend is that companies are staying private longer. And that means that, someone like a Cisco or Amazon, when they went public, they were valued at $300 million. Now you're seeing private companies doing financings at 100 billion or more. right? We're going to probably have I think we'll have a private financing at $1 trillion, right? Either either by one of the AI companies or SpaceX or somebody will do that. And so think of all the market value that's shifted from public markets to private markets. So as a venture firm, you want to take advantage of that. So what have we done? One, we've expanded across from enterprise to consumer to healthcare to AI and all these different sectors, fintech that now we support. So we're very broad from a sector standpoint. Number two, globalization. We've worked across now India. We work in Europe. We work across other major markets of the world. We're a global firm. We used to have we used to have a China effort, but that's no longer something we do because obvious the political tensions. And so, but the point is that you need to be global. And number three, companies staying private longer. We've established larger funds for those growth investments, right? And so we put a lot of money now into those investments that are working and those growth stage investments. And that's why we're seeing some of these companies raising capital at very large, numbers, but they're still good investments, right? It's much like you would look at investing in a high profile public company. They're just still private.
And they're private longer, as you point out, which translates into the event, the liquidity event, taking longer in many cases as well. I mean, you look at the number of companies that are public today versus 20 or 30 years ago, and it's a remarkable change. How does that change? I mean, across the 20 years that you've been you've run your own firm, 28 years as an investor. Is there anything that kind of changes your thought process in the necessity to think about some of these investments as longer term than they once were?
Yeah, I think the definition of liquidity has changed, right? It used to be there was two ways, well, three ways to get liquidity. Um, Sell a company, M&A, IPO, or shut it down, right? And two of those are usually pretty good. The IPO is the best, obviously. Um, Now, though, companies are staying private longer, and M&A is down, has been down, mostly because a large M&A has been somewhat restricted by the government. Now, this is a new administration, and that may change. But we're seeing a little bit of uptick in M&A, but not a ton. Um, what's happened though is the secondary market has, you know, been created, and that is that you can actually sell your shares, your private shares, on a secondary market to someone who wants to buy them as private shares. So you look at someone like Stripe. I don't know, they don't really need to go public because they have a very vibrant market for their shares. They run tenders for their employees on a regular basis. They don't have to deal with Wall Street, and they're managing the business in a very positive way. And I think you're going to see more companies operating that way. But you still need to be able to provide some liquidity for your employees and investors, and that's where the secondary market comes in. I think we'll continue to see that expand as a liquidity, and it also could be something where early stage investors might sell their stake to a later stage investor, right, who's willing to ride it for longer. So there's all sorts of things that are good about the secondary market.
Yeah, interesting points. I know again from our past conversations, Barry, that you refer yourself as not the strongest of technologists. You had an economics background at UCLA. You have an MBA from Stanford. You don't have an engineering background. You were not a traditional kind of techie person prior to getting into venture, as many are. And therefore, the way you've put it to me is you don't rely as much on technology IQ. You lead with EQ. And I wonder if you can kind of peel back that onion as to your superpower as an investor with perhaps a little bit of a different background than some of your colleagues and peers across other firms.
Yeah, no, and I never really thought about it as a superpower, and I'm not sure that it is.
Well, you've been
But
successful despite this fact.
yeah, yeah, but there's definitely people who are way more technical than me and can sit down with a technical founder and go into a lot more detail. Now we have people that can help us do that. So I never really felt like I needed to, go get an engineering degree. Um, and at some level, getting deep into the product is maybe not as important as understanding the market and the team. Um, but but still, there are a lot of very smart people in the valley. Very, very smart people. I think I found as a differentiator that EQ becomes pretty important, and it becomes important in your ability to um, get to know founders, understand what makes them tick, help them through their ups and downs, be a good listener, ask good questions, um, and relate to them, and be a resource for them to come to you when they need. Because being a CEO, private company CEO, is probably one of the hardest jobs on the white collar jobs on the planet. Um, you're guaranteed to go gray in 3 years easily if you're it's just a hard job. It's lonely. You have the whole company on your shoulders. It's a really difficult job, and you don't always have people that you can go to. So making yourself available as a board member, and having the EQ that allows you to be approachable, I think matters a lot. And when you're selling in deals these days, I think CEOs want to work with people they like. And so EQ becomes more important. And I think over time, we'll start to measure EQ, we'll start to measure it and value it more in investors.
Yeah, interesting perspective, certainly. You also have noted that you focus your efforts on providing leverage to entrepreneurs. So, what are the best ways to do so? How do your colleagues at Lightspeed make sure that that's the guideposts that you're trying to deliver?
Yeah, I mean, there's a fine line between leverage and overhead. And as a VC, especially as a younger VC, you always want to come in and be helpful, to the company. The challenge is sometimes what you're doing is just creating more work for the CEO than he or she would normally have. Leverage, I define as helping a company or CEO get something done faster than they would have ordinarily got it done. That's leverage. And so I think you know, as you think about how you're helping companies, making sure that whatever you're doing is helping them do something faster than they would have done it, and that it's worthwhile to do. It's a priority too, right? Sometimes you can organize these sort of needless meetings, and the CEO feels compelled to take them, but they don't go anywhere, and that's overhead. But sometimes you can organize these really high impact meetings that actually create a new opportunity, and they do go places. That's leverage. And again, it's hard to recognize one from the other, but it's very important to do so.
Yeah, well said. I also wonder, yeah, across 28 years of investing, has what you look for in an entrepreneur or a founding team changed at all? How has that been refined across the time that you've been investing?
Yeah, I mean, I think it varies by sector, right? Um, there are certain sectors where I think experience, building products in that sector matters more than others. You look at something, and I think enterprise is one of those sectors where some of the technology sectors matter. In consumer, Evan Spiegel was in college, so he didn't really have a lot of experience. He had built some products that before, but they hadn't really taken off. Um, so it does come down to some of the intangibles, right? It's not necessarily just the resume and the years of experience. That's important, but there's the intangibles of every venture is is a roller coaster. It just is. They all have ups and downs, and so how is this founder or founding team going to get through the ups and downs? Are they going to have the persistence, the drive, the tenacity, the grit? Some people use that term, to get through the hard times. Are they going to have the creativity and innovation to know when they have to evolve or pivot the product? Are they going to find those open opportunity, those open spaces in the market? Are they going to, run fast enough to win in today's market? I mean, we've gone from a market that operates at about 70 miles an hour to one in AI now that operates around 130 miles an hour. Are they going to be able to drive the car that fast and drive it through all the turns, without flaws? So there's a bunch of intangibles you have to look for in individuals. I wish someone would come up with a test that we could give people, that they could take. I think you just have to ask a lot of questions, but I'm sure over time there will be a test that we could just, administer and, fill out these 100 questions and then we know. But it's definitely not just about the resume anymore in this world. And I think it's also part of that is that technology's shifted so fast that younger people coming out of school who have experience with the latest technologies do have an advantage.
Yeah, that makes sense. And speaking of newer technologies and fast-paced evolution in those spaces, AI certainly is the talk of everyone, it seems, these days. And given the pace of innovation in artificial intelligence, you've noted the challenge of building a defensible position in that space. Talk a little bit about your thought process relative to AI and some of the differentiating factors between those companies that you think have, have at least a modicum of defensible position, or some of the factors that organizations need to think about in order to develop leadership positions in AI.
Well, I mean, the technology does matter. Um, in some of the cases, scale and financing matters. Right? In the case of the large models, scale and financing, and sort of ability to attract capital does matter a lot between the winners and the losers. As you go into more of the subsectors, um, I think that there are going to be some crowded markets, and so who is going to emerge as the number one player, getting there first, building the best product, getting customers, moving fast. I mean, moving at essentially warp speed. These companies have to do. There's always going to be a challenger because you can build these products so fast now with AI. Um, that you can't sort of say, "Gee, we're 18 months ahead of the competition from a tech perspective." Well, that doesn't exist anymore. The question is, how do you sort of create your moats in the market, right? And are they financial moats? Are they customer moats? Or, partner moats? What are they? Um, and the best companies are going to figure that out. But the way that we compete has changed because it's so easy to create these products fast now with the help of AI. So it's going to be interesting to watch and go back and look at this sort of cohort of companies and see, what did the winners do versus the 2005 or 10 cohort, right? And I think we're going to look and find that they did very different things to be the leader.
Yeah, very interesting. And are there parts of the AI landscape that you think are less tapped that excite you as you contemplate the broader landscape?
Boy, I mean, I think we're applying AI to a lot of things right now. There's certainly a lot of things that improve productivity that are, a lot of subsectors, the typical sort of enterprise software subsectors, and even things as simple as just coding, right, and development. Um, I'm excited by the acceleration of science by AI and whether that can then lead to discoveries that make our lives better. And we know that we have lots of large problems to solve in the world: health, climate. Whether you believe it or not, it feels like we've got an energy problem, right? We're going to need more of it, and hopefully it can be cleaner. Um, there's all sorts of things we're dealing with. The way that defense companies defend themselves is changing, right? AI is going to play a big role in that. Robotics is going to be, I think, one of the largest use cases of AI. And I just don't mean robots running around your house doing things for you. I mean, just how do we take autonomous humans and have them do tasks for us and have them be smart enough? And I think that's going to be a very interesting market. And autonomous vehicles, autonomous everything really is going to play into that. So we're in the first inning, and it's really hard to tell what the seventh inning looks like. But it's going to be the most profound, I think, technology disruption that we've seen in our lifetimes.
And it appears as though many agree with you, just given the amount of funding, the percentage of venture capital that's going into artificial intelligence investments. Are you at all concerned about a bubble forming? How do you
Yeah,
think about that?
yeah, we've just started to use the term bubble with respect to AI, and I sort of was thinking about that. I mean, bubble means the hype is way above the reality. The thing is, with AI, the reality is pretty amazing because these companies are generating revenue and growing at paces we've never seen before. So the hype must be even, you know, out of this world to be a bubble. It's possible. We most of these technologies go through. I do believe in the sort of the Gartner curve, so the Gartner sort of adoption curve, where we have the hype cycle. We're really high in the hype, and then there's the trough of disillusionment, and then we sort of come back to reality. And maybe we need to go through that with respect to AI, and maybe we will. But I don't know that there's been a technology that will impact our markets and our productivity as much as AI has over the last 50 years.
Yeah. Given how amazing that reality is, as you point out, I wonder how are you using artificial intelligence? How has it improved your own personal workflows? The extent to which you're leveraging
I
it
use
for your work.
we're investors in Anthropic, and I use cloud every day. And I try to learn how to use it, and not just asking questions, but using it for productivity. I want to create a document, I want to create this or a report, or I want to get smart on something. How do I do that? And I find I'm getting better and better at it every day. It's funny because let me do a little sidebar here. There's this notion in universities that they're all trying to figure out how much to let students use AI. And there was this initial reaction that, gee, we shouldn't let them use it at all because they're just using it to write papers, and that's bad. They're not going to learn how to write and all that kind of stuff. And but I think we need to arrive at a place that says, hey, there's certain core skills we want students to learn, but utilizing AI and becoming good at using AI and making yourself more productive is a skill you should learn in college. And if you don't, you're going to be left, you're going to be behind people that do. And so I think universities need to embrace AI and figure out how to use it more. I've been doing some work with UCLA, um, and one of the things that we've discovered is that you can actually use AI to help you generate course curriculum, syllabuses, and create courses. And you can create them 100 times faster, and you can do it and create expert personas to help you do it. And so you can create courses faster, and you can create better content that is more well received by students using AI. And so that's just an example of what they can do. Now, if universities started to embrace that, that might help them also embrace letting students, leverage AI for their work.
Barry, one of the fascinating aspects of your background is you're a rare venture investor who's actually from Silicon Valley. You grew up in the area, Sunnyvale, I think. And describe the Silicon Valley of your youth compared to the Silicon Valley you now occupy and work in and presumably live in as well.
Yeah, I grew up in Sunnyvale, in sort of the 60s and 70s, and we had my I it's the neighborhood I lived in was carved out of a cherry orchard, and so everyone had cherry trees in their backyard, and there were cherry orchards all over the place, and some apricot orchards, and you know we'd run around and you'd ride your bikes to the cherry orchards, and it was there just weren't a lot of buildings, and the biggest I think employer at the time was Lockheed in Sunnyvale. Um, but I remember being 8 years old and going over to my friend's house, and we were just running around. And his dad was the only person I knew that worked in tech. and I want to say he worked for Fairchild, but I forget who it was. Um, and he had this big device sitting on the counter by the phone, and it looked like a printer, essentially, that we would say, like a desktop printer. And I said, "Well, Mr. Barrett, what is that?" And I'm 8 years old. I'm like, "What is that thing?" And the phone was sitting on it. And he goes, "Oh, that's a modem." I go, "What's a modem?" And he said, "Well, a modem can take a document like this piece of paper, and it can send it over phone lines, and then you can receive it, on the other side as a piece of paper with, you know." And I was thinking about that, and my 8-year-old brain is trying to figure out how this would work, and I couldn't figure it out. And he sort of explained it to me, it went over my head, but I was like fascinated, and that really started my curiosity with tech. And of course, as tech started to invade the Silicon Valley, it became clear to me that if you wanted to live in this great place, this nice climate that we have and beautiful place, that you needed to learn tech. So
Yeah,
there's still a couple orchards left, but not many.
I wanted to also ask you, Barry. I recently spoke with our common friend John Chambers, and your name came up. It was as part of a conversation about the remarkable alumni network of people from Cisco. And I know that was a formative experience for you as well. Can you talk a bit about what was so special about that, your 6 years with the firm uh, that you, like so many, have taken with you on to bigger and remarkable things that transpired since?
Yeah, Cisco was just a fantastic experience for me. I got to, in my first experience meeting someone from Cisco was while I was in business school. I got connected with John Mortgage as an alumni mentor, and John was the CEO of a private company called Cisco. And I got to know him, and one thing led to another. And I was one of the first people they hired out of a business school in 1991. And the company had just gone public. It was tripling in revenue every year, growing like a weed. People hadn't seen this before. It was a darling of tech. And John Morgage was just a fantastic leader, set the tone for the company. And I learned a lot just from watching him. And he, I think, taught a lot of people. John Chambers was emerging. He had joined as a VP of international sales and eventually became CEO. And I got to actually help John do his first acquisition as CEO and got to know him and work with him closely. And speaking of EQ, that man has more EQ than I've ever seen in anybody. He can walk into a room, read the room quickly, know what to say, and get things done in a very positive and constructive way. And he knew how to run fast as a team. So, and I've still kept in touch with John Chambers, and he's now on my side as a VC. But we don't talk much about the Cisco mafia because there's PayPal mafias and other more prominent mafias. But there's a lot of people that came out of Cisco to start companies and also join venture capital. Jay Sri Yalal, who's done a great job at Arista, and Charlie Giancarlo is running Pure, and there's a number of other people I'm missing that are running companies that were there early on. There's also a bunch of people that are now in venture. Mike Volpe's had a fantastic career in venture, and a number of others. But there's a really broad list of the Cisco Mafia, and I'm excited and proud and feel fortunate to be part of it.
Yeah, no, that's good. Some really nice reflections, certainly, Barry. Anything else that excites you as you look to the future? Any sort of last reflections here as you contemplate how the other world continues to turn?
We have so much going on politically and so much going on technology wise, and AI really is a going to be a defining technology for humanity, right? How we deal with it and how we use it to either solve problems or create problems. And it's going to be interesting to watch. Um, and hopefully we can all impact it in a positive way. But I think this is definitely a crossroads. AI presents a really serious crossroads for humanity, and I hope we get it right.
Mhm.
I'm optimistic we will, but I hope we do.
Yeah. Anything in closing, anything you'd recommend to others that you read or listen to or watch uh, that keep you informed?
I don't listen to the news much, and I don't really read much news because I think it's all editorial. Um, I'd rather just talk to people, and hear about what they're and I did spend a little bit of time in Washington talking to lawmakers. You have to sort of filter that a little bit, but no, I don't. There's really I don't have a great source of information, that I can trust, and I think that's sort of a common problem people have today. I would love to have that Walter Cronkite source.
Yeah, very interesting. But also, I think in some ways reflective of your EQ that you can fill your mind with a lot of facts and theses and test hypotheses as a result of the great network that you've built. And I'm grateful, Barry, that you're a member of mine. Thank you so much for your willingness to continue the conversation. Thank you for sharing a bit about your history as an entrepreneur within the venture capital space, having founded one of the great firms and sharing a bit about its evolution in addition to some looks forward as to what might come. It's been a great conversation, as it always is.
And a pleasure, Peter. Thanks for having me. Great conversation. Thank you.